The clients right now that are freaking out are ones that either don't have a good advisor confirming their risk tolerance, setting up expectations, and then monitoring it and communicating it so that the person's not wondering what's going to happen. I've said this over and over again. You never know what a client's risk tolerance is until the market drops significantly. Hi, I'm Annette Ba'u, host of the Wealth Inside and Out podcast and founder of the Millionaire Insider. My mission is to help you simplify the money game so you can create a financially secure and fulfilled life without having to have a PhD or spend countless hours on your finances. You're going to learn how to think like a millionaire, stop worrying about money and wondering if your financial house is truly in order, and instead spend your time doing what you love. With over 3 decades advising 7, 8, and even 9-figure millionaires, and now joining that elite group, I'm in a unique position to help you make the best financial choices so you can create a secure financial future and retirement you love. This is the Wealth Inside and Out podcast. Today's show notes, you can go to themillionaireinsider.com/107. If you need additional support, you can go to themillionaireinsider.com/SR. And the reason I'm going to give you that resource is because when it comes to investing or market analysis or timing the market or anything related to your investments, you've got to be working with somebody qualified. And if you don't have somebody qualified, then you've got to spend the time and do the research and learn how. If you go to themillionaireinsider.com/SR, you can access me or one of our advisors and be able to get the information you need so that you're making an informed decision. And I encourage you, before you make any change, you've got to consult with somebody who knows what they're doing. That's better than just going and doing something. And we're talking about a lot of concepts today. Some of them could be disastrous for you and your situation if you don't have somebody qualified working with you. Again, themillionaireinsider.com/SR. All materials, forms, and intellectual property are copywritten by themillionaireseries.com. Before beginning any plan, you agree to consult with your own team of advisors and review your situation. All participants agree to hold millionaireseries.com and its affiliates harmless for results achieved or not achieved. Any reproduction of this material is allowed only with written authorization from themillionaireseries.com. This is not about giving investment, financial, tax, retirement, any type of financial, tax, estate planning, any type of advice. You've got to do that with your own team of advisors. And you agree to hold us harmless because we are not here recommending you do anything. I'm giving you insight so that you can go and find a really good, qualified, competent advisor and get help from them. And you can do that at themillionaireinsider.com/SR. All international copyrights and information are reserved. What I find commonly happens is that there are 3 groups of people. The first group is very concerned about the current administration, regardless of what side it is. So they're very concerned, they pay attention, they micromanage, and that's one group. The other group, and these are probably the 2 extreme groups, are really comfortable with the current administration, and they go to sleep at the wheel. And then there's a third group of people that they might be concerned, they are aware, but because they're properly allocated and they are comfortable in the amount of risk they're taking based on their age, their goals, their time frame, they're not as concerned as the group that is completely uncomfortable with the administration. One thing I hope you leave with from this standpoint is the fact that regardless of who's in the White House, you got to be paying attention. Anyone that pays attention knows that there's pros and cons to anyone that's in office. And I know I'll probably get flack for this, saying, how could you say there's anything good about the current administration with all the things that are not good? But my point being is, from a financial perspective, ideally, we've got to look at the big picture, and any good advisor is going to do that. So if you have an advisor that's saying, everything is great or everything's terrible, and they're not able to see the bigger picture, probably not an ideal advisor. As far as the third group that is properly allocated, and I will say this much, my portfolio lost over, let's see, it lost about 130,000, one of them. My more growth oriented, my profit sharing plan. I'm not going to take money out of that for like 15 years. So it's like, oh, does it really matter? I've got stocks I like. Now I did buy some more when it was way down. That all said, I've been reallocating my clients' portfolios for the last year, and none of my clients have a really high level of risk. So they're all positioned very well, and they have guaranteed income. We've pretty much created their own pension plan within their plan, unless they have a pension. So there's not a lot of risk. Now, for myself, what I looked at, and thank gosh I did this about a year ago, is I said, I'm making these recommendations to all my clients. Why don't I do it? And especially when I started seeing the power of, investing X amount and letting it percolate, where you're getting like these 10% roll-ups. Now they're not as high. No, they're still like, just saw one recently, it was like 9.25. Now again, this is not a guarantee. They could change the roll-up going into effect, and then the income I'm going to get in 5 years, 7 years, 10 years, whenever I elect to take it, you have that flexibility. That's something that obviously tells you a lot, because if you have a good advisor and you're really clear on your risk tolerance, you're going to be a lot less concerned about it, as compared to the clients right now that are freaking out are ones that either don't have a good advisor confirming their risk tolerance, setting up expectations, and then monitoring it and communicating it so that the person's not wondering what's going to happen. I see a lot of people right now that are really concerned, either because they don't have an advisor, they have not reevaluated their risk, or they have an advisor that's basically so gung-ho about what's happening, maybe more from a political standpoint, that they're like, oh, things are going to be great. I've heard so many people say, well, my advisor said things are going to be great now. And it's like, well, maybe so, maybe not, right? And I think that in and of itself is a little bit concerning, because I don't care who's in office. There's always potential for making money, and there's potentials for losing money. I remember when I made this decision on my own personal monies a year ago, thinking it's probably the biggest mistake I made, because assuming if, one party gets elected, the market, you would think, would go up a lot more than another one. But at the same time, I'm like, I've got to do what I'm recommending, and I always do that. We'd already done it with other monies, but last year we made a really big play. Thank goodness we did. So knowing that I've got X amount of dollars, it makes this market volatility a lot less impactful for me, since I have in my own personal portfolio lost a bunch more money than any one of my clients. So that's something that's important to understand. It was funny because I've had like 3 or 4 people say, oh my gosh, I bet you are like so busy and your clients are freaking out. And it's like, actually, they're not. And so I just thought that was really insightful. And it's just something to kind of gauge where you are. Meaning, if you're nervous, worrying about the market or your money, you either have too much risk or you don't have a proper plan for your future. And when you don't have a plan or you have too much risk, it's normal to worry. When you're properly allocated and you've got a plan, you won't be worrying about the future. Now, maybe you need to save more money. Maybe you need to figure out a different plan B. But the point is, when you have a properly allocated plan and you've got the right risk, you're going to worry less. That is pretty much a guarantee. And there's not a lot of things I can guarantee, but that one is pretty true. That's assuming that you have money. Now, let's just say you don't have money. Then you've got to get a plan around how you're going to make more money and how you're going to save more money and invest more money. But it all centers around your risk tolerance regarding your investments and then your plan regarding everything else. So let's talk about 5 different insights. I think the first insight that is so critical is you've always got to be ahead of a market adjustment. So you got to get ahead of it. And how do you do that? You do that because you create a plan before the market adjusts. People that have done that are not freaking out right now. As far as getting ahead of market adjustments, it's a matter of looking at your risk profile. Now, any professional that you deal with is going to help do a risk assessment. They're going to help you determine how much you can handle on the downside and how much you can handle on the upside. And so on the downside, if you look at it and say, okay, I have $100,000, all right, I could handle losing 10%. Like I could go up to minus 10%. if it got 15% or 20%, I'd freak out. Now, some people would say, oh, I could go down 25%, meaning $100,000, they could lose up to $25,000, so they'd only have $75,000. Everyone's different. Some of us that are a little less aggressive might be okay with 10 to 15%. It starts getting more below that, and we get a little nervous. All right, so that's the first thing to know. The second thing to then know is based on that risk you can handle on the downside is what amount of return, a guesstimate, because there's no guarantees, that could you get on the upside. Now, most people are like real growth oriented when the market's going up, not so much when it's going down. So I think the second point I would bring up, making sure your risk tolerance is accurate. I've said this over and over again. You never know what a client's risk tolerance is until the market drops significantly. And then all of these growth-oriented investors are all of a sudden just wanting to get out. What can I do as far as from a standpoint of getting more conservative? Because they're really not growth-oriented. Everyone's growth-oriented when the market's going up, not so much when the market's going down. So we've got to get clear on that. And it's kind of like really getting clear on saying, okay, if you lose 10%, so now you had 100,000, now you only have 90,000, I want you to really think about how you're going to feel. Or 80,000, or 70,000, or 60,000. There's a lot of people that would freak out if they lost 10 or 15%. My portfolio at the highest was down 13%, and I own mostly single stocks, which I don't recommend, but I'm comfortable with the portfolio I have, and I'm also really comfortable because I've got a significant amount of money that is in safe assets that's not subject to risk. So that's, again, something that we all have to look at and know. But the first one, is getting ahead of market adjustments. The second one is confirming that your risk tolerance is accurate. Because people I'm talking to, it isn't. And some of them really haven't even done it. And it's like you can't expect to be okay with market adjustments if you're not really clear on what your true risk tolerance is. So we got to get really clear on that, okay? That's number 2. And then number 3 is timing the market. I look at all these people that the minute that the president was announced, they went into cash. They're like, oh, I'm so glad I'm in cash. Well, and they might be glad they're in cash, but this is the issue, my friend. I don't care who is leading the country. I will agree that somebody who is a little calmer, who's a little more strategic, who doesn't just fly by the seat of their pants and brings more calm versus chaos, the markets are going to like better, okay? That said, when you're making decisions on timing the market based on one specific thing and just because you don't like person or something like that, it's not always ideal because it's very hard to time it. It's very hard to know when to get out, and it's very hard to know when to get in. And what ends up happening is you end up getting out at the wrong time or you end up getting back in at the wrong time. Most money managers aren't great at timing the market, and they have a lot more access to data than we as individuals do. I mean, yeah, we do as advisors, but the average person doesn't. And so you just got to be careful of that. And what I find, and this is so interesting, is that I find when people think the market's going to adjust, it rarely does. And when they don't think it's going to, it does. It's weird. And so it's just not always what you think it is. And some of it's consumer confidence. So consumer confidence last month was 7.2, the lowest it's been in a long, long time, I think since COVID. The issue that they brought up, the person that they were interviewing said, the most interesting thing about this is that it's so low. And one of the key factors is that typically a person's like, I don't have a lot of confidence in the economy or what's happening like that. But in this particular situation, what they were concerned about is that its impact on them. So there are a lot more people right now concerned about what's happening with the firings, what's happening with the economy, the cost of goods. I mean, for crying out loud, I love avocados. They're like, what, $2.50 each? I'm like, oh my gosh. I said, I don't care what we do. We might have to buy an avocado farm. I love avocados. I'm not giving up avocados. And I'm not giving up decaf, and I'm not giving up tea and, a good wine. So I'm like, oh my gosh, so much of this is going to be impacted by the tariffs. I did buy a new Apple phone. My son plays volleyball, and my doggone camera is not great. And I'm like, I don't want to deal with it. I'm not going to pay $3,500 for an Apple a phone, so I'll just go ahead and pay the $1,200. My point being is that we've got to look at these indicators. And so when the consumer confidence indicator was so low, what they were finding is that people are now realizing that a lot of these cuts and a lot of what's happening is not just happening to people out there. It's happening to themselves or their extended family and friends. And that, my friends, is a big one because it's really easy. And I think, especially with this election, it's a lot of people would probably agree, is that a large part of the plan to really cut government, the plan to cut Social Security, Medicare, Medicaid. Now, a lot of people say, oh, no, I don't care if Medicaid's cut, but I don't want Medicare cut. And a lot of people don't understand that a lot of people that's going to impact. Because I can't think of one of my clients that hasn't been impacted by it. They've not needed Medicaid, thank goodness, but their siblings have, their children have, their parents have, their friends have. And so the reality of it is that it might not impact you directly, but it's impacting those around you. So that's something to be aware of. But getting back to this consumer confidence report, well, how that impacts the overall economy is when a person goes to the store, now all of a sudden they're saying, wait a minute, I've got X amount in my budget to be able to buy groceries. They're seeing everything go up, so they're paying attention to that. Even more important than that is that when consumer confidence goes down, and somebody's thinking about going on a trip or somebody's thinking about buying ticket shows, all of a sudden they're saying, I don't think we should. I think we should wait and see what's going to happen. And what ends up happening then is people aren't spending money, and that's going to cause problems in the economy. Or we still have this ongoing war with China. And the one thing I'll just say, and I'm not an expert at communist countries, but my husband has worked a lot over in Asia. And he said the one thing you got to bank upon when you're dealing with certain cultures is that they are long game focused. So if they're told, and part of it is they don't have really a choice, right? But if they're told that this is a 4-year deal or this is an 8-year deal, they'll hunker down and they will go with it. They will do what they need to do because they're focused on the long term. Now, in a communist country, they don't have a choice. The issue here is if they do hunker down and they say, they just keep going up, we're going up, they're going up. But the issue is that if we start seeing those prices go up, it's going to impact inflation. And inflation had already risen this last couple months. And so that's probably going to happen, right? And we already know that it's going to be interesting to see the next jobs report because the last one was good, but that was before the tariffs. And now we've got, I can't even think of the name of the company, but the one that was Chrysler, they laid off 900 people. There's been reports of several people laid off down in Kentucky with the alcohol and tariff war we're having with Canada. And those things are going to impact the economy. The other thing I want to add about a lot of these cuts that are being made in the government is that as an advisor, I would be a lot more optimistic if the goal were to reduce the deficit. Because anyone that's paying attention knows that we've got a ticking time bomb that is just getting worse by the day. Some people were excited that there are more cuts in the government, that there was going to be more efficiency. I think the way they've gone about it is kind of absolutely crazy. But that said, if the goal really were to become more efficient and to reduce the debt, I think there's a lot of people that would be a lot more on board. The reality of it is that a lot of these cuts have been made to be able to give wealthy people tax cuts. Now, they said it's going to be the top 5%. I think really, if you look at it, the ones that are really benefit are the upper echelon of net worths, which is like the billionaires. I'm seeing reports as far as on the recent tax proposal, anywhere from 5 trillion added to our deficit up to like 7 trillion. Whether it's 5 or 7, it's a lot. And I think you got to really watch that because that is going to have a huge impact, not only on the economy, but more importantly on what's going to happen with taxes in the future. So again, that's something to really pay attention to. Now, let's just say you're somebody that says, I'm very nervous and I'm very concerned. Well, what you can do is you can get out of the market, meaning you're in like a high yield performing money market fund. And then what you can do is dollar cost average back in. Now, if it's personal monies and you have huge gains, you need to look at that because that might not be the best option for you because now you're gonna have to pay capital gains tax typically, or ordinary income tax, depending on how long you've held the investment, if it's less than a year or more than a year. So you got to be aware of that. If it's personal monies, definitely analyze that with your CPA, your financial advisor, before you do anything, unless you're just so panicked that you're like, I don't care, I'm going to still do it. I still would recommend you consult with somebody. But then what you can do with your qualified money, and we've done this with a few of our clients, is we just get into a high yield money market and we dollar cost average back in. And we're a lot less concerned about what's happening in the market because every month they're buying a certain amount. And if it goes down, they get to buy more shares. It goes up, they buy less shares, but overall you think it's going to even out. Now, I've seen so many reports, and I've never seen a report that a person makes more money from doing that. I could pretty much guarantee you if they're doing that in a period of time where there's a huge drop and they miss that huge drop, clearly that would be more beneficial. And I've seen portfolios that, thank goodness they weren't mine, but in 2008, when the entire economy collapsed, and it was really pretty much a financial collapse, seeing portfolios that were down 40 and 50%. And so the issue now is the time it takes to make that up. And some people, it's taken them like literally 10 to 15 years to make up what they lost in that downturn. So that's something to be really aware of. I think one of the things that's really unique with what's happening right now, and I think this gets back to consumer confidence. When I originally recorded this, the consumer price index was a minus 7.2. They just announced it right now, and it's minus 11. So it's dropping rapidly. So again, that's just something to look for. It's just what I want you to get is that this is information that impacts the markets and that you need to be paying attention to. If you're managing your own money, you want to be looking at as many indicators as you can and then making an informed decision on where you should be allocated. It'll give you an idea, there's no guarantee, but an idea of where the markets are heading. For example, most people have not been talking a lot about the bond market. The bond market is really why Trump pulled back on his tariffs. When the confidence in our country starts going down, people start selling off treasuries. And what ends up happening then is they're selling them off, rates are rising, it's not a good scenario. And that, I think, freaked a lot of people out because when you have a country like ours that's issuing debt to be able to pay for our debt, and people have a lot of confidence in our country, and all of a sudden now they don't have confidence, that is a problem because that is like the foundation. So those are all things to watch, things to be aware of, things that can impact your money and your life. In 2008, I was really, really nervous because the entire financial market was crumbling, meaning banks were potentially defaulting. And I mean, it was problematic. And that was, I think, concerning for a lot of us. Now, it came through and it was a miracle that it did. I still, to this day, I can remember laying in bed and I just remember because it was Bush had just gotten out of office, Obama had just gotten in. And I just remember thinking, he just doesn't have the experience. Now, the one thing I'll say to his defense now is the part of the good thing, and I think the reason it turned out so well is because he didn't have the experience, but he had the ability to consult with people who did. And that made all the difference. And that is why we survived that and actually came out on the other side well. And then you look at what the market did his entire time in office, it was unbelievable. And it has been literally unbelievable since really 2008. Yeah, we've had a couple blips, but nothing sustained. That said, the concern more with what's going on right now in the markets, in my opinion, is that this is basically man-made. The law, and I'm not a lawyer, but from listening to enough lawyers, is if there ever is going to be a tax on American people, it's got to have congressional approval. And in essence, a tariff is a tax. And so what I don't like is the fact that these are all happening with executive orders. And executive orders have been going on for a long time, and I just don't agree with it. Because when you have one person, and I don't care what side of the aisle you're on, it's just not advisable, because what ends up happening is you've got somebody on this side who's making all these crazy decisions. He gets out of office. You got somebody on this side that's making crazy decisions. The reason we have 3 levels of government is so you don't have that craziness. So I personally do not like these executive orders. And I really think that if you are raising taxes, because in essence, a tariff is a tax, we're going to be paying more. We're going to be paying a lot more. Now, I think what's going to happen is people are going to start speaking up. If people start going to the grocery store and they keep seeing things get higher and higher, you're already seeing, the protests, you look at how many people were in the hands-off protests. That said, people are speaking up because now more and more people are being impacted. And the thing that interested me most about those protests were listening to the people that some of them even voted for the current president. Other ones were pretty much centrist. They weren't really, either way, but there were certain aspects of that was impacting them and their families. The more people that get impacted, the more people that feel it in their wallet, the more people that feel it in their retirement, the more people that are going to speak up. And I think that's something that, again, leads to consumer confidence going down, possibly inflation going up, if prices rise, even going into a recession, if not depression. I just hate to hear either of those words, but a lot of economists have been saying that and continue to saying that. And you hear more with recession than depression, because I think depression sends people into, a scare zone. But dollar cost averaging can be an effective strategy for that, instead of timing the market, so that you're putting X amount of dollars in. One of our clients was a little bit concerned about the market probably 2 years ago. And I was too, just because we had just come out of COVID. There were just a lot of uncertainties. So we took their money, put it all in the high yield. We dollar cost averaged it in. And then literally just in the last, quarter, we did it again. And we were in literally high yield, all cash, high yield, and the market just falls out. And it's like, oh my gosh, what great timing. But again, those are things you got to be careful with. You really can't market time. You just got to be paying attention. And if you are nervous and you want to get out of the market, then I say get out, but get back in. And again, then you always have to check your tax status. Now, some other things that I want to talk about, what can you do to protect your gains? And I think that's a great question. There's various ways, right? But one of the things that you can do if you want downside protection, you obviously can buy a traditional annuity. And traditional annuities, there's a lot of them, but there's one that's more focused on growth. And that would either be like an indexed annuity where you're buying index funds, or there's a variable annuity where you're buying more underlying mutual funds. But in both of those, the focus is for growth. Okay, and then you're going to grow it, and then at some point you're going to have X amount of dollars. And one of the things that people love about those is that you have a hedge against the downside, meaning you don't have to worry if the market, you lose money. You'll never lose money, no matter how much market drops. You're not going to make as much on the upside, but you'll never lose money. So that's one option. Another option, which I like better, is where you put money in. And again, it is an annuity. It's more of a deferred income annuity, but you're putting money in, and you've got 2 values. You got your accumulation value, which is how much it grows over here, and then you've got your income bucket. Now, when I put a client into a deferred income annuity, I'm focused solely on that income bucket because that's what they want it for. So what happens there is you get a crediting rate, whatever that amount may be, and it's going to change, and you get that for a certain number of years. And then you get a payout based on how much that value has accumulated. So whatever that end number is, they're going to take a percentage of that, and that's what you're going to get as far as income stream guaranteed for your life. I love those. Those are one of my absolute favorite. There's no risk on the downside. You've got guaranteed income. It's like your own personal pension. All right, so that's number 2. A third option is what's known as a RILA. A RILA is a registered index-linked annuity, and a variety of companies offer them. But what I like about them, and I was just at a conference, and it's so funny how you sit next to somebody. I drove to the airport. Our driver took everyone from our hotel back, and I sat next to this gentleman, and he started talking about him. And I'm like, oh, I've heard of those, but I'm just not super familiar with them. Well, basically what they are is it's with an insurance company. It's a form of an annuity, but the difference is they are fee-based. They're not commission-based. So there's no cost to get in and there's no cost to get out. But what they do is you can go in and you can select different buckets. And so in this particular situation, they allow you to decide how much downside risk you want. So you could go, like you could say, okay, if the market drops 10%, 15, 20, 25, and it might even gone higher, but we'll just focus on those. What they do is they say, okay, let's say I can handle a 10% drop in the market. So if the market drops 11%, you would lose 1%. So on $100,000, if it went down to 90,000, you lose zero. But if it goes down to 89,000, which would be 11%, you would lose 1,000. And then 15, you could go down to 85,000, you wouldn't lose anything. It goes down to 84, you're gonna lose 1,000. It goes down to 83, you're gonna lose 2,000, and so on. But then it gives you an upside. What you can do is on the upside, you've got X amount of dollars that you can earn in that specific index. And so, you can just basically look at the different scenarios. Now, I'm not here to recommend any one product, and you have to look at it and you have to look at your situation. What's awesome about it is you can go into different buckets. You can go into a bucket where, you can protect yourself on the downside, say 10%. And then if the market's positive at all, you get X amount. And I mean, the numbers are fascinating that they can do it. I had one client say, I'm not at all interested. And I said, okay, well, that's fine. But before you say no, let's just have a conversation. We get off the call. He's like, where do I send my check? This is unbelievable. So again, it might not be right for you. You always have to check with your own advisor, but it's an option. It's something that I would encourage you to take a look at and consider. If you're not sure that your retirement plan is in order, I encourage you to download our retirement plan checklist. You can go to themillionaireinsider.com/RPC. This checklist is just going to give you insight on what you may have missed or what you're not thinking about or what you need to be doing right now to ensure that not only are you going to be okay now, but as long as you live. Again, themillionaireinsider.com/RPC. Let's review the market update, options of what to do now, and how to think. So number one, you got to get ahead of market adjustments. Like you cannot be waiting until the market adjusts and then freaking out about it or worrying about it. You got to get ahead of it. Second, you got to make sure that your risk tolerance is accurate, that there's no question that the amount of risk you're taking, you can handle. And when it drops, you're like, that's what happens. Now, I hate losing money, but at the same time, I know that to earn the money I want to earn over the course of my life and what I want to achieve, that you got to take risk. And so when you think about it and the market goes down, and even when you've lost a lot of money, you still can look at it from a standpoint of saying, I'm not taking this money for like 15 years. Number three is timing the market. Timing the market is just dangerous. And a lot of people try to do it. I've just never seen that be a good option. I've never seen a person make money at that. Number four, if you do have concerns and you do want to mitigate your risk and you've looked at it from a tax perspective and with a qualified advisor, you can go to themillionaireinsider.com/SR. Dollar cost averaging can be really powerful. You put money in a high yielding money market and then you invest every month in an allocation that is appropriate, again, for your risk tolerance. And then number five is to consider something like an alternative investment like a RILA or an annuity, something along those lines. And again, before you invest in anything, you've got to make sure that it's appropriate for you, it makes sense. RILAs typically would be better for somebody a little older because if you take them out before 59 and a half, you're going to have a penalty. There is an adjustment that would be made if you take it out before the period, meaning like if you have a 1-year period, there could be an adjustment on the value. So again, you've always got to be checking not only with a qualified advisor, but really reading the fine print for any investment. All those are considerations. So on that note, I want to thank you guys so much for attending this kind of impromptu market update, but I felt it was really important with what's going on. And hopefully it provided you some insight just to be thinking about where you are, what you're doing. And more importantly, if you're not properly allocated or you say, oh my gosh, I should have done this a year ago and I didn't, then now's the time to do it, right? And just make sure that you look at what happens. I told you I lost $130,000 in one account. Well, yesterday it was up $57,000. Now today it's probably down a little bit. No, it's back up. It was down about 13,000 and now it's probably back up another 2 or 3,000. So, I mean, it's all relative, right? And no one likes to lose money. I don't know of anyone that likes to lose money. But that said, one of my favorite stocks, and again, I cannot make any recommendation on stocks or investing. That is for you to do with a qualified advisor. But one of the stocks that I invested in literally is up 20 points. So that's the power of it. So on that note, you guys, make it great. I'm Annette Ba'u, founder of Millionaire Insider. All international copyrights are reserved. Bye for now.